Maneesh Dangi, good morning. How have you been, my friend?
Good morning. Good morning. I'm good, man. How are you?
All well, all well. Haven't spoken to you in a while. Where are you
Yeah.
joining us from? Because every time you join us from some exotic location. Sometimes it is Rajasthan, sometimes it is a holiday home. Looks like this is your office, your house.
Yeah, sort of office.
Okay. How you been otherwise?
All good, man.
Okay. When we spoke to you last, you said that you were all in. You were buying perhaps the biggest risk on trade, which has worked like a charm for you to buy US tech stocks. Nasdaq is up 44% this year. Good call. Now what's next?
So, so in India, Nikunj, as I wrote to some of my friends, and I think even to you, that it's incidental that we're talking today because it's the second anniversary of me turning bearish on Indian assets, and you you gave me an opportunity to talk about it in 2021, and I was sort of both bearish on bonds and equities as well as Indian currency then. And what have markets done in this period in last 2 years is actually 0% in US dollar. And so whatever you sort of earn about 12, 13% is because of currency depreciation. And you would have earned as much in fixed deposits. So there's absolutely no risk premium available, is what I argued then in 2021. Now, lesson, of course, first for last 2 years is for anyone and everyone is that unless you solve for both macro and valuations, don't dial risk. The question, of course, what you now ask is, has the setup changed and, is there something to be extracted from markets now? Macro is, of course, a lot better today. CAD, currency, crude, rates, everything is, super good as far as India is concerned. As you said, US equities had become sort of super cheap December and we all dialed it, made money. But that was a trade, is done and dusted now. We exited last week. Now you are actually looking at a recession cliff, earnings cliff in US. Indian valuations are anything but cheap even now, Nikunj, and Indian economy is anything but shining. It is shining on TV screens, but it's okay. It's a mediocre growth profile that India has right now, and you can't pay top decile valuation, which you're paying right now in India, and hope to have insurance bundled in. So macro is decent, but because of that, macro big sell-off won't happen, but returns would be pretty much same that you earned in last 2 years. Very mediocre, very little in dollar terms, very very little, so to say. So that's what I think, Nikon, in a big picture sense.
Now, since you are an asset allocator, you look at macros and then you decide the next course of action. Give us a flavor of short term. When I say short term, 3 months. When I say medium term, 1 to 2 years. And when I say long term, 3 to 5 years. What, according to you, should be a good asset allocation? Short term, medium term, long term?
See, a very long term, I'll start because an easy one. It's very likely that you'll have sort of a garden variety recession in US in next 6 to 9 months time, and after that it'll be fine there. India is likely to decent, very likely a 6% real growth and 5-6% of inflation, so 11-12% is a bit expensive, and which is why it returns overall would not be that great, but still would be double digit most likely over next 5-10 years. So that's long term. Short term, very difficult to call. I just called last week that S&P 500 is peaked, and if you consider that S&P and Nifty actually correlate, even in last decade they would have correlated about 90%. So the all calls of decoupling and all have been sort of course super wrong, and so to that extent, if I'm lucky and got the S&P 500 call right, then it's very likely that your short term looks very wobbly and bad. Then there is sort of a more nuanced, what do you call it, a medium-term outlook that you could build for an investor, and that is 1 to 3 years. It's likely that in next 6 months' time, markets would get busy now. That yes, the much called recession since 2021 is actually now arriving. Tight financial conditions in the US, especially how much rates have risen there. As the consumer actually or household run out of the savings of fiscal largesse, it's likely that he would actually tighten the purse, and he or she. So therefore, I think US would get into some bit of a recession, and that's never a good news. I actually argued last week why every recession on average actually leads to about 20-21% earnings reductions. So in medium term, which is, at least 6 to 9 months out, or, if there is a recession and therefore a year out earning decline, I think it sort of makes sense to, even in US, which otherwise has become now expensive, it sort of take the chips off and be careful. And I think you will, in all sorts of markets, India may not correct as much because Indian macro is decent and earnings may not decline. But Indian earnings may not rise. Indians are baking in about 40% increase, Nikunj, and it's very unlikely that you will get disappointment. The 40% increase in next 2 years won't likely come. So I think in medium term, the returns are going to be somewhat more moderate than the long-term expectations of yours, is what I would sort of argue for the investors.
Hi Manish, this is Anish also joining in the conversation. So you said you've exited the US market last week. You're saying that Indian markets are still a bit expensive and there are still issues, as far as the market is concerned. So where should one look at deploying the incremental money? What are you doing?
Look, for the pure macro guy, there's an opportunity arriving. I've been a bond bear since 2021. I've made this argument on your channel many times, but it's done now. You are a very, very significant, almost, once in a history sort of tightening has played out in US, and US treasuries 10 years are trading at about 415, 420. And I think there's an opportunity there. So for a big macro allocator who have an access to US markets, I think an opportunity in next couple of weeks' time to sort of dial US Treasury if you're actually now starting to build a US recession view. Indian bonds actually still some time away, but I argued on your channel that, this short-term 1 to 3 years actually look decent, and that's where you can be overweight. Indian markets, of course, because, it's one of those markets where the likely earnings will not fall off the cliff in a significant manner. You could still be relative to US now. I'm making just the opposite argument what I did in December. Relative to US, you could be actually overweight India. So that's how an asset allocator, would actually, it's a jigsaw puzzle. You keep moving few things here and there to go overweight and underweight. So that's how I would look at, a little bit of a long short bonds in India, long US treasuries in next few weeks. And within India versus US, you would look at India more favorably versus US right now. But again, in absolute terms, you will have to be underweight equities because equities both in India and US actually are pretty expensive.
Okay. Now for our viewers here, Manish, who do not have the liberty or understanding or the wherewith to, let's say, buy into US bonds or invest in US tech stocks, they won't understand what to do in India. So if a simple allocation perhaps for Indian investors and our viewers is FD, cash or FNO. These are the three things in which they move. So are you saying that it's time to hunker down some equity exposure, move it back into a government paper or perhaps into a fixed deposit?
So, Nicholas, I'll tell you something more interesting, which I told some students last week, which is sort of, I think investors should look to increase surface area, all sorts of investors. We're very likely talking to someone right now on your TV show who is already fully invested in Indian equities and are anxious as to, why everyone, prices are not going up. I think, we should guide him to add at least two more assets, Indian bonds and Indian US equities. Then we want to all reach out to people, both me, you, and asset gatherers want to reach out to the ones who actually you talked about, which are predisposed towards only fixed deposits. And FDs are not only assets in the world, and they should add, of course, local equities or international equities. So in a sense, because, the key point is that the markets are intrinsically cyclical. No story, including that of India, is secular. Chasing past performance never helps. By increasing the surface area, investors are increasing the chances that, they will get some opportunities, and, that will help them avoid the fear of missing out in any particular asset class. So the one-trick ponies, Nikunj, who perpetuate the myth that there is no other option but Indian equities, do so because they don't have other tricks up their sleeves. And that's true even for the fixed deposit, the fear mongers. So I guess increase the surface area, have these assets sort of at least know them, and, as and when they're cheap, dial them, is how a broad, big picture view I'll try and tell to the on your show. Yes, to the people who are predisposed towards FDs, I think, mutual funds in the fixed income space are giving decent returns. and you should. And it's not a absolute undialed time for Indian equities. If you're absolutely zero in equities, you should continue to add through SIP or some systematic route. Buying local indices or diversified fund.
Okay. Manish, what would be the importance of next year's election cycle for absolute asset allocation? Because there would be a swing factor which could be at play.
Yeah. Nikhil, of course, when I worked in a corporate, the first thing we were told is that never talk politics on a TV show. But I don't work with a corporate, so I would sort of take the liberty actually to call it out, which I've shared with you. That I think on politics, at least what we could say for sure, that markets are mispricing uncertainty associated with it. At least I don't know which way it will lean, but how certain that markets are of the kind of government that it wishes, and the kind of the government which it wishes that will support a general stuff like what we've got, which is tax cuts and such, and less redistribution, more infrastructure. It's very likely that next 5 years, at our 2024 onwards, you will get a different form of government. Could be incumbents return, could be sort of another coalition takes place. But in any case, the mandate would be different than that of 2019. And to that extent, I think people are underpricing, both in bonds and equities, the risk associated with Indian polity. It sort of swings from one direction to another, Nikunj. And we've had a government, which is sort of which actually favored infrastructure over redistribution, much like people talk about Modi as more of a socialist. He's been a pretty sort of capitalist guy. So I think it's likely that the form of government, which changes every 10 years, at least in ideological leaning terms, I think it would change. And that actually is not good for financial markets. It perhaps is relatively better for real assets.
Dangi, always a pleasure to have you on ET Now, and certainly hope to see much more of you going forward.
Thank you.